Hello traders, Gary Wagner here, just about 10:45 in Honolulu, 3:45 in New York on Friday. Happy Aloha Friday, as we say on the islands, February 19th, 2016, and this is the Daily Report for gold and silver combined with trending markets. First, let's take a look at gold. Gold has had a very nice move throughout the week, although it is trading lower as we go into the close. We did hit a high today of about 12.34 in the market. Market currently trading off about $4 at 12.26. Low on the day about 12.20. So we're certainly trading about mid-range on the day. As we go into the close on the equities markets, it does appear as though we will see lower pricing on the day for the Dow Jones Industrial Average, although it is up on the week, actually with a very nice showing overall on the week. S&P's also trading lower today, trading currently at 1913. That's off about 3 points. So traders, the first thing that I do want to do is to cover our current trade, take a look at a short-term forecast or look at the market as well as our longer term forecast of the market. I'm speaking specifically about gold. We did enter a long trade earlier this week in which we got in the market right on this candle here as the market was trading at about 1207 to 1209. We're marking ourselves long at 1208. Now that, of course, is after we had this market have a tremendous rally to the upside, taking it to an intraday high of about 1263. Of course, our traders got long on this particular rally, not near these lows, of course, at about 1080, but we did enter the market and we began to get long roughly at about 1111. It came in roughly at this area. As the market moved up, it broke out. We added to that position at roughly about 1221. So we had double of our positions, and the primary reason was the break really above these recent highs told me that we would have an extended rally in the market. That was my belief at that point. We did cover part of that, or the first leg of that position, a little bit early. We got out, I think, at around 1160, 1161 in that area, and then carried the other remaining position as this market moved up. We trailed our stops up, and when the market began to come down, not here, but on this particular candle here, it did stomp us out at 1229. So we were able to ride a really good portion of this trade up. We exited the trade, I believe, at a very good point. As I said, we got out roughly at 1229, and then we sat in sideline for the better part of a couple of days. As the market came down, and this is where our current trade, of course, comes into play, but as the market traded down, we noticed a couple of things, and the primary thing we noticed was that in terms of our Elliott wave count, we had some fairly strong evidence that we could in fact be looking at a tentative bottom, and this was the math and the consensus behind what we were looking at. We had our first leg of our rally, which took us roughly from about 1040 up to these tops at about 1110. Interestingly enough, when the market corrected, it corrected exactly 61%. That's where these lows came in. I believe they were around 1071. Then we had an extended rally. We just talked about the trades that we did in that rally. We profited quite nicely from that, and that rally actually took us to about a 261% extension of wave one when we consider the close of the market, not necessarily the high. The high actually exceeded that. But so that told us that we were on track to see this market begin to weaken. And then this last sell-off that we had really throughout the end of last week, beginning of this week, took us to a 38% retracement. And the fact of the matter is that typically on a Elliott Wave 5 count, you will get one deep correction, 61%, and then one more shallow retracement, whether it's wave 4 or wave 2. You typically don't get two deep retracements and typically do not get two shallow retracements. So the fact that we had weathered our 61% retracement here led me to believe that there was a substantial opportunity that we will find some sort of bottom action in the market. Now, when we had the green candle that came in on Wednesday of this week, this is when we actually issued the buy signal, got into the market roughly at 1208. We originally had our stops sitting under 1189, which is these lows right in here, and we did move those stops up yesterday. So traders, maintain your current long position at 1208. Maintain your current stop that is sitting just under 1200 per ounce. So lastly, in terms of our current trade, I do want to touch upon our current exit strategy. And the exit strategy obviously assumes that we do not get stopped out. We will look to continually trail the stop higher if we see the market as it moves up throughout next week. Of course, we'll have to see how that unfolds. But in terms of our exit strategy, you look at basic models of a wave 5, and wave 5 will typically be equal to that of wave 1. The interesting thing is that wave 1, when you simply extend it to 100%, it puts you up near these tops right here. So you would, in essence, just get an equal high to the high that we saw at the end of last week when the market touched upon 1262. The level above that is below 1300, and that comes in at 1298, and it's 161% extension, and that would be the upper end of our exit strategy. So I believe that if this trade provides fruit, meaning it continues to rise, this is the basic target or area that we will look to cover our current trade. So traders, I do want to cover my longer term view of the market as it stands currently. And of course, we've been looking at this particular Elliott wave count over the last 3-4 weeks. We've also been looking at these particular areas as a real potential long-term bottom in the market when we hit these recent lows end of last year, beginning of this year, trading to a low of approximately 1045. As you can see, I have basically two fib retracements. The first one begins roughly middle 2006 at about $500 an ounce, up to these particular record historical highs at about 1900. And when we do that, we actually get a 61% retracement at 1051. You can see that right here. And so that kind of falls into line for some sort of a bullish model. Because for a bullish model really to have some sense, you don't want to see a retracement or a correction more than a 61% retracement, because that's telling you you're absolutely in a bear market. Now, under this particular wave count, we are then labeling this as a major fifth. And from a major fifth, we go into an A wave, then a B, then a C. Now, it is our current belief that we have concluded this long-standing A wave, which took a number of years when you consider that the top came in middle of 2011 all the way through 2015, and our count basically states that we've got a wave 1, a wave 2. This low here at about 1200 comes in for our wave 3, takes us into a double compression triangle. So we've got wave 3, wave 4, and then we go into our final wave, fifth down. You can see these blues are the sub count behind the intermediate count, meaning wave 1, wave 2, wave 3, wave 4, and a final wave 5. So we have our subcount 5, minor 5, intermediate fifth concluding there, as well as our long-standing major A. What that means then is that we are now in a B wave. And so the B wave itself is what we're attempting to plot. And the way that we typically will look at it, you can see this dotted or dash, this dash line of 50%. And what this retracement is referring to is 1051 up to these record highs, meaning the entire range that we saw occur in gold as this market sold off, and that 50% retracement takes us to 1475. Now, the reason we're looking at that as, and again, this is a long-standing move, but is that typically a B wave will be anywhere between 50 and 75% that of A. Now, this is not something that's going to happen overnight. This is going to be a long-standing move. When you consider that this major A really unfolded, was a multi-year wave, my sense is B is going to be much shorter, but it still is something that I believe will be ingrained in throughout the year. This being the first clip of that, this being that first one, and it is a subcount one, of course, but this one is what we're looking at right now. And once we complete this first wave, that will give us a much better idea, because we will then have our benchmark that we utilize for all of our subsequent waves, waves 3 and waves 5, as well as wave waves 2 will all be benchmarked off of wave 1. Of course, wave 4 will have its benchmark off of wave 3. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for another daily update and review. Bye-bye.